that anyone here and anyone who wasn't able to join us today will be able to watch the webinar at another time. So without further ado, I want to welcome everyone. Thank you for joining us here on your lunch hour today. I am pleased to introduce our alumna panelist or host of this webinar today, Lena Nebel. She is a YCP graduate from 1999 and is the director of financial services, right?
Mm-hmm.
Financial planning.
Director
of Financial Planning at BFG Financial Advisors. So without further ado, I will let her take the reins and tell us a little bit more about how understanding our employee benefits. Welcome.
Great, thank you. Thank you again, everyone, for joining. And again, I appreciate you guys taking your time during your lunch break. Hopefully some of you are eating lunch right now as I'm going to speak. Please, I want this to be interactive. So if you have some questions, use the chat box. I'll answer them as they come up. Bridget will let me know, and that would be great. Otherwise, I'm going to put my contact information at the end of the presentation. You could always reach out to me separately if you had specific questions relating to your actual benefits. I am a certified financial planner with BFG Financial Advisors in Timonium, Maryland. So this is a lot of what we do in talking with our clients and looking at their benefits. So I thought this would be a very timely presentation given the fact that it's open enrollment season. And so what I thought I would do is make this very generic in nature, kind of covering a few main areas, and then we can get as specific as you like. To begin, there's basically three types of benefits that your employer may offer you. There's career, personal, and financial. We're going to spend the bulk of our time on the financial side of it, but when looking at some of these other benefits, it's important to consider when looking at a new employer, or maybe giving suggestions to your existing employer of adding in some additional options. So career benefits, those are typically tuition reimbursement programs, membership to an organization related to your industry, assistance for continuing education classes. So career benefits are ideally those types of benefits that are going to further your career. Personal benefits could be something like a gym membership. It could be credit towards various health programs. I know with our company, we have a health savings account, and it will track your Fitbit based upon how many steps you make. There's a contribution that goes into your HSA. So trying to reward people for staying active. And then other personal benefits could be, there's a lot of programs to help new mothers. There's pet insurance. So again, personal is going to be kind of your overall well-being. And financial benefits are typically where most people spend their time and what they're concerned with, especially when looking at a new employer. They're looking at the financial side. So on the financial side, I thought we would start with insurance. And I broke it down into three different types of insurance. There's the health insurance, life insurance, and then some type of disability insurance. And I think health insurance is the one type of insurance we all know. Most of us are using it in some form. And you have obviously different options ranging from various deductibles, copays, prescription coverage. Something that's becoming more popular is actually an incentive if you don't take insurance. So what I mean by that is, if let's say my spouse had insurance through his employer and I had health insurance through mine, his company may incentivize him to go onto my program because it's cheaper for the company if they're not covering any of the employees. So they may offer him some type of credit for not going on the health insurance. So that's becoming very popular over these past few years. When comparing different health insurance plans, you don't always want to look for the cheapest type of plan. You want to find something that's going to work with you and your family based upon, your needs. If you have regular visits, if you have certain prescriptions, if you have certain procedures each year. And then, of course, you always want to check with the doctor to make sure that they're going to be covered under your new health insurance. And that's the same with whether it's medical or dental and vision. you always want to look too, when thinking of health insurance, how it's going to relate to long-term retirement planning. When you think about your expenses in retirement, this is going to be typically one of your highest expenses that you have. And I think we can all agree health insurance has gone through a lot of reform over these past few years, and I would expect more of that happening too between now and the time you retire. But that is something that you want to take a look at, is what would be the cost of insurance when you retire. There's what's called COBRA insurance, which would allow you to extend the coverage of your existing employer plan if you retire, you quit, or you're laid off. Additionally, if you have a spouse that passes away and you were covered under their insurance, there's rules that allow you to continue that level of insurance too for a certain time period. And then lastly, under insurance, if you're not employed or you're self-employed and you need to go on to, let's say, the state exchange and looking at health insurance option, each state is different in what they allow. So you may live in Pennsylvania but work in Maryland, you're going to be looking at Pennsylvania insurance. And so when individuals are thinking about retirement and looking to move somewhere, health insurance is going to be one of those big factors to consider. Under health insurance, there's what's called health savings accounts. Health savings accounts have become extremely popular over these past few years. We're a strong believer in these types of programs. They're one of the few ways in which you can truly get tax-free money. And so what a health savings account is, it's allowing people who are covered by a high deductible health plan to receive tax-preferred treatment on medical expenses. And how it typically works is you have your premium for your high deductible plan, and in addition to that, you're making a contribution into your health savings account. That HSA is pre-tax, so every dollar that goes on there is reducing your taxable income. And when you take that money out for medical reasons, it's tax-free. One of the best ways to use this is to not touch it until retirement. This is not a use it or lose it plan. That money can roll over from year to year to year. So if you're putting in, let's say as a family, $7,100 a year, and you do that for 10 years, that's over $70,000 that you've accumulated in that plan that can help to pay for those retirement medical expenses or long-term care needs in retirement years. If you decide to take that money out for non-medical reasons, there could be taxes and penalties depending on why you take it out. But the best way to use HSAs is basically don't touch it. Just allow that money to stay in that account. You can invest it. There's a variety of investment options that you can use in the HSA. You could be very aggressive or very conservative. So it allows those dollars to continue to grow. And again, it's one of the best vehicles out there, very similar to a Roth, that allows you to shift money into that without looking at income needs, which is important. So you can really build up some significant savings in those HSAs. On a flexible savings account, this is the use it or lose it plan. So this is the plan where when you enroll, you want to make sure that you're setting aside the right amount of money depending on what your expenses are going to be in that calendar year. You can use your flexible savings account for healthcare expenses, dental bills, as well as dependent care expenses. So if you're using it for the medical side, you're limited to $2,750 a year that you can put into that pre-tax. And if you're using it onto the dependent care, let's say you have a little one that's in daycare or an after-school program or summer camps, you can set aside $5,000. Both of those are spread out through your paycheck through the year. And when you put that money away, again, that's a pre-tax expense. And when you take that money out, it's tax-free for you. So if you have daycare bills, you're going to have those bills regardless. You might as well save $5,000 in the dependent care, so you're getting at least a $5,000 tax reduction for you in that calendar year. Each year, the IRS puts limits on if they're going to increase those amounts. They have not been increased for 2021, so it's the same amounts or the amounts that I just had given you. That may be something that's going to increase over time because it's a valuable tool for a lot of individuals. But the issue is if you have money left over, what happens to it? So if you only use $4,500 of your dependent care and you have $500 left, you lost that $500. So you want to make sure that you have the ability to spend the dollars that you're setting aside, which is why you'll see dentists become very busy at the end of the year because people are trying to get their cleanings or getting cavities taken care of. People enroll in the FSA for dental bills if their kids are going to be getting braces one year, so you can try and plan accordingly for oral surgeries and things like that. Under life insurance, I put on here a few different types of life insurance. There's the employee life, supplemental, spouse and dependent, and then accidental death and dismemberment options. So typically with life insurance, with most employers, you have a free level of coverage. Typically it's one-time salary or a $50,000 benefit. That's completely free, no underwriting necessary. If you want to purchase additional insurance, that's your supplemental insurance. And so for some employers, they could go up to 7 times your salary, or maybe it's 3 or 4 times your salary. And sometimes there could be underwriting involved, depending on how much of additional insurance you're asking for. Sometimes that underwriting is just a questionnaire, and sometimes that underwriting is having somebody come out to the house to go through a formal application with you. Traditionally, employee life insurance is cheaper than if you go out on your own and purchase life insurance. And the reason being is that you're pooling the ages and the health from all the employees together, which is what keeps that premium down. But the problem is twofold. One, your premium will increase each year. And 2, if you leave your employer, you lost that insurance. So sometimes what we would look at is getting the free insurance, and then whatever the gap is that we need to cover, we'll look outside of the group plan to get the insurance. If I have a client who has some health issues, some underwriting concerns, then what I'll do is we'll purchase the additional insurance through their employer so that we have that limited underwriting. You can do the same thing with a spousal and dependent insurance. You traditionally can't purchase a lot of insurance for your spouse or dependents. It's usually $25,000 or $50,000. But again, it would be something if that's needed. The last type of insurance is what's called accidental death and dismemberment. This is traditionally AD&D insurance. A lot of people that I talk to may end up telling me that they have millions and millions of dollars of life insurance. And when we go through the numbers, they actually don't, but they consider this AD&D some form of life insurance benefit. The problem with AD&D insurance is that you have to die a certain way for the policy to pay out, or you have to have a certain limb that is lost in some way. There are a lot of hoops that you have to go through to have these policies paid out. They're the cheapest type of insurance, which is why people end up buying a lot of it. And this is traditionally the first type of insurance we tell people to cancel because 9 out of 10 times it doesn't pay out. Obviously, there's accidents that happen all the time and that it could, but just from a risk factor, we think that you could put your dollars into other places instead of the AD&D policy. I didn't put this on here, but obviously other types of insurance options could be what's called cancer insurance. So for some individuals who maybe have some cancer history in the family or they're concerned about that, there's different policies that employers can offer that would pay some type of additional benefit if you had that type of prognosis that had come out. I'm working with a client right now who's going through that exact same thing, and she actually has cancer. And so we're going through the insurance company on getting a payout because she was just diagnosed with that. It's rare to see some of those types of policies out there. You see them in much larger organizations, but again, it's an option that's available. And then another type of insurance is disability insurance. Disability insurance, there's a few different areas to pay attention to. A lot of people, surprisingly, don't enroll in their disability plan. And I think a lot of that just has to do with the fact that they're not understanding what the disability plan actually is. And there's two forms of disability. There's short-term and long-term. Short-term typically covers, your first 90 days of some type of illness. For women who are pregnant and going on maternity leave, this is traditionally where they would use, which would be the short-term disability. Short-term disability is 9 out of 10 times covered by the employer. The employee is not paying for it. And like I said, it's usually about 90 days worth of coverage. And traditionally, it can cover up to 100% of your salary. After the 90 days, assuming you're still disabled and you've met all the qualifications of becoming disabled, then you would go into long-term disability. And long-term disability usually pays until age 65 if your disability is lasting that long. And at that point in time, most individuals would end up going on Social Security disability, which is why the majority of policies stop at 65. The issue with long-term disability, though, is that it doesn't cover 100% of your salary. It only covers usually 60 to 65% of your salary. So for many who become disabled, there's a significant gap in coverage. So for those individuals that have the ability to buy up additional disability insurance, it's best to do that because you want to try to protect as much of your income that you can. Individuals, most of the time, I see individuals just have disability plans, no outside policy. Whereas in life insurance, they would have group life insurance and outside policies. Where we would typically see individuals that have an outside disability policy is doctors, high income earners, or self-employed individuals who are creating their own benefits. There's a lot of things to pay attention to with disability, like the waiting period. How long do you have to be disabled for before your benefits kick in? And then your benefit period, how long your benefits are going to pay. So again, when you're enrolling in your benefits, if you have the option to buy up your long-term disability plan, it's usually best to do so because your existing long-term disability won't cover 100% of your income. And then another type of insurance that can be available through your employer is actually long-term care insurance. And long-term care insurance is what you would call, your nursing home care, assisted living, adult daycare. For many individuals, purchasing this through the group can be more affordable than purchasing it outside of your employer just because of underwriting and cost. This, however, would not be something I would recommend if you're 30 years old, starting a job, and you want to enroll in long-term care. This is something that you would enroll in when you're in your mid-50s, is the opportune time to look at those types of policies. What we do quite frequently is for clients who have the opportunity to purchase long-term care through work, we evaluate the benefits that are offered through work versus outside of work to make sure that it's effective for them and they're getting all the bells and whistles that they would need for their situation. On to more of the financial side, we have employee stock plans. I can definitely get into the weeds as it relates to the various stock plans available through the employers. But again, trying to keep it high level as well. This can be something that can be extremely complicated. And I would strongly suggest if your employer has one of these three options or all three, that you coordinate with your financial advisor or your accountant because they can have some pretty drastic effect on your long-term planning. So starting with an employee stock purchase plan, very simple. This is basically the employer giving the option to the employee to purchase their company stock at a discount. Traditionally, that discount is 15%, which is nice. So you're actually buying shares for less than what your neighbor could purchase those shares for. But the catch is you typically can't make changes to how much you're buying for a certain time period. That could be through the course of a quarter, that could be the course of 6 months, or even a year. So you do not want to put a lot of money into something like this if you're limited for a year, because if you have a cash flow issue, you can't change that contribution. The other thing is you are limited on when you can sell the stock. So if I go online today and I go into E-Trade and I purchase shares of Amazon, I could turn around and sell it immediately if I wanted to. With employee stock purchase plan, you're limited to when you can sell it. There are time frames. So you could purchase it at a discount, but you may have to hold on to that stock for 6 months, and during those 6 months, it could have a drastic drop in value, and you just gave up your discount. So it's important to understand your limitations on buying, and it's important to understand your limitations on selling. Assuming that you're able to sell it for a gain, keep in mind there'll be some tax impact in doing that as well. So for a lot of people, it may seem attractive to purchase the stock at a discount, and it can be, but just make sure you're reading all the rules regarding that stock purchase plan. There's restricted stock units. A restricted stock unit is when your employer is giving you shares of the company, and it has a certain vesting period. So let's say you're granted 100 shares that vest over 3 years. So each year you're getting a third of those shares that you can sell, you can hold on to them, you can do whatever you want with them, but they're giving you that stock. That is a taxable event when those shares vest, but like I said, you can do whatever you want with that. So if you decide to hold on to it and sell it later, you may have capital gains or you may have losses that you have to pay taxes on those gains. So again, CPA should be brought into that conversation, or your financial advisor. So again, the employee stock purchase plan, you're physically purchasing the shares. A restricted stock unit is where the employer is giving you those shares. And then a stock option, there's actually two different types of stock options. There's what's called non-qualified and incentive stock options. And the difference between the two is primarily how you're holding it and the taxes when you decide to sell it. But basically what a stock option is it's the employer giving you the right to purchase the shares at agreed upon date, price, and quantity. So remember, a restricted stock unit, they're giving you 100 shares, it may vest over 3 years, and you have that. With a stock option, they're giving you the option to purchase those shares. So let's say they're giving you the option to purchase 100 shares each year for the next 3 years, and they've already set the price. So let's say they set the price for $10 a share. So you know how much it would cost you if you decided to buy that. And then you can determine, based upon how the stock is doing, if that's something you want to purchase. And then depending on how you purchase it and when you sell it is really when those taxes would come into play. Many times, employers can have all three of these options in addition to having stock in the 401k, company stock. So it's really important to think about diversification and making sure that you're not overweighted into your company stock, because you want to make sure that if something happened to that company, that you're still doing very well, and that your risk isn't subjected to what's going on with that company. A few things on the stock options to consider as well is what's called the expiration date. You want to make sure that the stocks don't expire, they don't lapse, and you've lost that opportunity. So the expiration date is going to be extremely important. And then again, just making sure when looking at overall diversification on how much stock you have. For some individuals, even though you have the option to purchase the shares, it still may make sense to purchase and then eventually sell them at some schedule, when keeping in mind what your taxes would look like. And then, and when I say your taxes, I mean kind of your household taxes. So if you're married and you're married filing jointly, you need to consider your spouse's income into this calculation as well. So that's why I recommend that it's good to bring the CPA or the financial advisor involved to kind of map out what your vesting schedule is and exercising schedule as well. But employee stock plans, very popular, but can also be very complicated because of all of the rules and restrictions within both. Under retirement plans, I'd say out of all the financial benefits, a lot of people, this is where they'll kind of focus on. They want to know, well, what's their 401k match? And this is how they're growing their assets for retirement. And this is where the bulk of us have our money, is in some type of employer retirement plan. So within retirement plans, there's a few different types of retirement plans. There's a 401k and a 403b. They're the most common. The difference between the two is a 403b is for tax-exempt organizations like your college, churches, local governments. You may hear the terminology of a TSP, which is a thrift savings plan. That's the retirement plan for the federal government. And there's also retirement plans that are 457 or 401. There are retirement plans that are considered supplemental deferred comp plans. But again, your traditional ones are your 401k and your 403b. All of those other plans can be supplemental plans that give you a few more resources in how to save, but the mechanics of all of those, for the most part, works the same. Within those retirement plans, whether it's a 401k or 403b, your employer may actually have a Roth option. So what that means is you have the ability to save on an after-tax basis money into, let's say, a Roth 401k, and that grows completely tax-free. This is not a Roth IRA. Some people get confused and think, well, I've made a Roth IRA contribution, I can't do a Roth 401k, and that's incorrect. So the Roth IRA, you're limited by your income, and you can only put in $6,500 or $6,000 into the IRA or the Roth IRA. In a Roth 401k or Roth 403b, you can go up to the limit of $19,500 if you're under 50. If you're over 50, you get to put a few more $1,000s away. But it's not capped on your income, which is important. So it allows you to grow an asset tax-free. Now, again, just like the stock options, you want to consult with somebody because you don't want to put everything into the Roth 401k or 403b. If you have a high tax bracket, you may need some pre-tax savings. So you could do a combination. You could say some of this money is going to go pre-tax and other money is going to go into the Roth and try to have a healthy balance. You're trying to perform a tax balancing act. How do I help myself now but not hurt myself later? Because as your 401k, as your retirement plans grow, anything that's pre-tax will be taxable to you at some point down the road. And most people think that their tax brackets are going down in retirement because they're not making as much money. But if you're still spending the same amount of money, you have to take it from somewhere. And for most people, it will be in the retirement plans, which will be taxable. So a lot of retirees are actually in the same tax bracket that they were in when they retired. We're in a very low tax bracket right now, and that can easily go up these next few years. So that's something to consider, is exploring the Roth options. If your employer has a match, keep in mind the match will go onto the pre-tax side. The match will not go into your Roth account. Only your employee contributions go there. So a match, I like to say, that's free money. That's what is your employer giving you for the privilege of having the 401k. Traditionally, this could be 3 or 4% of your contribution or of your income. Others, it's a formula that may be 50% of the first 6%. So that basically is another way of saying they're putting 3% into the 401k. But you want to make sure if your employer has a match, you're getting that free money. So if you have to put in 6% to get 3, put in 6%. You want that free money. That's important. And a lot of people don't pay attention to that. Some employers have profit sharing contributions that don't even require you to make a contribution. So when you're switching benefits, or if your employer is coming out with a retirement plan, it's important to understand all the mechanics of how that match works, as well as the vesting schedule. You want to make sure, if let's say you're leaving your employer, that you're not leaving any money on the table. So when you get your 401k statement, you may see something that says vested balance. Vested balance means, what if you leave your employer? What are you taking out of that 401k? How much of that 401k is yours? Because your contributions are always 100% vested. But your employer contributions, I'm sorry if I misspoke there, your employee contributions are 100% vested. Your employer contributions may not be. You may have to stay there for 5 years or 3 years to be able to get that entire match. So before you put in your 2 weeks notice, make sure you know what if you stayed an extra 30 days, would you have hit that vesting schedule? So make sure you understand what that schedule is if they have one. And then, of course, lastly, with retirement plans are the investment options. Investment options are important. Do you have 20 options to choose from? Do you only have 5? Most employers have really cut back their investment options within the retirement plans because of all the rules now on becoming a fiduciary, and the employer doesn't want to be liable that you chose the wrong fund and that caused you to lose all this money, or you didn't have a certain investment option available to you. So there are limitations to your investment options within a retirement plan. A common question we get is, should you roll out your retirement plan when you leave your employer? That's going to be case by case specific, but the only benefit in rolling it out to, let's say, an IRA is you control the asset, you control that investment. So you would then have more investment options available if you opened up your own IRA account versus leaving it with the employer. Regardless, you want to make sure that you're diversified. You want to make sure that you're picking an allocation that's aligned with your goals, your risk tolerance, your overall plan. So that's the benefits in working with your financial advisor. They can come up with that allocation. You can readjust it annually. I caution you about readjusting it more frequently than annually. Additionally, it's important when you're making your contributions, as you get raises, increase your contributions into your plan. It's, out of sight, out of mind. You're paying yourself first. Every time you get, let's say, a 2% increase in pay, increase your 401k contribution. That will have a dramatic impact long-term for your retirement plans. The last item, it's not on here, but I definitely want to make note of it because I see it all the time. People don't list beneficiaries on their retirement plans, which, it's amazing how often we see that. It's amazing how often we see the former spouse listed as a beneficiary and the new spouse not too happy about that. So you want to make sure that the retirement plan beneficiary is listed. I think all of you will say, I know who my beneficiary is, but keep in mind, if you had to fill it out on a piece of paper, somebody had to enter that in. So you may want to trust, but also verify. Some employers may require you to update that beneficiary every year to verify who it is, and they're not going to be knocking down your door, making sure that you have a beneficiary listed on there. So you definitely want to log online or look at your statement or call the provider and say, who do I have listed as a beneficiary? And if you don't have anyone, make sure you list somebody on there. Lastly, just to kind of tell you a little bit about who we are. Like I said, we're a financial planning organization in Timonium. We truly believe in empowering families through financial planning. We do a lot of free resources out there. I encourage you to look at them. We host webinars like this. We have podcasts. We have some free ebooks out there. My partner contributes multiple articles on Forbes.com. You can follow us on Facebook and LinkedIn to get a lot of that information. And again, here is my contact information. So if you had specific questions for me about your benefits, or maybe something that I said triggered something for you that you kind of want to sit down and look at it, again, there's my email and phone number. Use me as a resource. Fellow YCP alum, it'd be great to meet you. I'm class of 99, as Bridget said, so please, again, use me as much as you can to get any information on the finances, and I encourage you to follow us on some of these areas because we do push out a lot of great resources for everybody. I don't see any questions in the chat, but if you guys have any questions, please feel free to pop right in. Excuse me.
Thank you, Lena. Yes, please submit questions. And while those questions are coming in, I just wanted to let you know that if anyone here feels like you would like to host a webinar, maybe you have an expertise like Lena, or just maybe it's not related to your professional area, maybe it's a personal passion. We are really excited to lift up our alumni and give you a platform to share some of that knowledge that you have. So if you're interested in hosting a webinar in the future, please email us just at alumni@ycp.edu. I'll drop that in the chat. It's pretty simple, and we'll find a date and time that works for you. But I know I had a question, actually. So going back to the HSAs, if you leave a company, I know that you said that the funding that's in there stays indefinitely, but how does it work if you like leave a company and perhaps you sign up for an HSA at a different company? Is that the same pool of money? How does that work?
Yeah, great question. So what you can do is you can actually roll over your health savings account from the old employer into the new employer. So you would contact the new employer's trustee. There's a form, a transfer form that you would fill out. It's a non-taxable event. And we always recommend clients consolidate their HSAs because there are what I call nuisance charges, to where they may charge you $1.50 a month for the privilege of having the HSA. So you want to make sure if you have outstanding HSAs, you just consolidate them all together. And like I said, there's no taxes involved in that. But keep in mind, you can only consolidate from like to like registration. So what I mean by that is, Bridget, let's say your husband has an HSA and your employer just came out with an HSA. You can't roll his health savings account to yours. Okay, he can only roll his HSA to another HSA in his name. It may be a family plan and you get to share that benefit, but the owner has to stay the same.
Okay, yeah, that's good to know. Thank you. I'm not seeing any other questions either. So
I guess I just described everything to where everyone's good to go. So that's great. Like I said, everyone, I appreciate you taking your time today. Bridget, thank you for the opportunity. This was great. Hopefully I'll be able to come back and give some other useful information too.
Yeah, we'd love to have that. And again, this is recorded, so we'll share it with everyone who registered and even those who maybe registered and couldn't actually join us today. And then it will be on the website as well for people to visit and anyone can watch. So thank you so much, Lena, for sharing your knowledge with us. I know it was really incredibly helpful for me and I appreciate your time. So thanks everyone for joining us.
Thank you. Take care, everyone.
Bye.